The S&P 500 and NASDAQ hitting new highs this morning as the government shutdown is in its second day. Our next guest says the deadlock in Washington doesn't change his overall strategy, but he did make some moves for Q4, including lowering communication services to a market weight from overweight for the first time since 2023. Joining us now is Scott Chronert, U.S. equity strategist at Citi. Scott, great to have you on here. So big picture, it feels as if, the constructive forces remain in place, I guess, as long as earnings come through.
Well, Mike, that's sort of our mantra. We're going to lead with a view towards fundamentals from here, and we'll allow macros to influence at the margin. But right now, the fundamental setup, in our view, is still very solid. It's led by this growth part of the market with the AI tailwind. To your point, we did make a tactical decision to lower communication services, which is where your big internet names live, from a longstanding overweight to market weight. This begs a different issue as we go into the quarterly reporting period, and that is how much good news is being priced in the stocks. And we do this reverse DCF work. We call it implied growth. And what jumps out at us on these media names is that there's a lot of expectation being built into these next prints, such that the burden's going to be on beats and raises. I think just making or beating numbers may not be enough to support the stocks near term. Still positive on the tech sector, particularly semis and software. So we're still very much on board with the AI train.
I thought the move to consumer discretionary to market weight was sort of interesting, Scott. Are you feeling a little bit better about the consumer, or are you just feeling better about the valuation of the group?
Well, Melissa, I think where we're going with this is what we're trying to do is play this balancing act. We're talking increasingly about we've got two markets we're trying to navigate. The half that's roughly influenced by AI, and the other half that's going to be more akin to traditional macro metrics. And so what we're allowing for here as we go down this next phase of Fed rate cuts, we want to be aligned a little bit more aggressively with those areas of the market that should fundamentally benefit, if not immediately, as we go into 2026. Consumer discretion is part of that. We're particularly keen on the retail component, which is where you're going to catch an Amazon, but as well on the consumer durables and apparel, which is where the home builders live. And so what we're trying to do here is dial up a little bit at the margin how we're thinking about positioning for traditional lower interest rate sensitivity.
And on that score, Scott, I know you kind of warmed up to small and mid cap after kind of letting it pass by earlier this year. Is that mostly a rate story?
It's the same thing, Mike. So essentially, when we think of small mid cap versus large cap in particular, much more traditionally economic sensitive. Ideal time to own small cap is coming out of a recession. We're not there. We're still looking at the soft landing backdrop. But soft landing plus lower Fed funds rates does begin to set this up. Now, fundamentally, I'd also make the point that small mid has been in its own form of earnings recession over the past 2 years. With Q2 results, we had the first positive inflection in earnings growth in that 2-year time frame. And so we're looking at that persisting going forward. So a combination of traditional historic rate, lower rate sensitivity, combined with signs that we're turning corner in terms of the fundamental setup, has us incrementally more constructive on the SMID space as well.